Ever wonder how the super rich pay less taxes? You see them flaunting their yachts and private jets. You hear about their billion-dollar empires. But have you ever wondered how much these super rich folks actually pay in taxes? It's a question that boggles the mind, right? Well, get ready for some eye-opening information. The truth is, the wealthy often pay a smaller percentage of their income in taxes than you and I do. How is that even possible, you might ask? The answer is surprisingly simple. They use completely legal strategies to reduce their tax burden. And the best part, you can too. Before we dive in, let's be clear. We're not talking about tax evasion, which is illegal. We're talking about tax avoidance, using legal loopholes and strategies to minimize your tax liability. Think of it like this. You wouldn't walk into a shop and pay full price if you knew about a discount, would you? Of course not. You'd grab that discount code and save yourself some money. The same logic applies to taxes. The tax code is complex, and it's filled with provisions that allow you to legally reduce your tax bill. The rich and their savvy accountants know this, and they use it to their advantage. But now, you can too. One of the biggest secrets to how the wealthy minimize their taxes is through something called capital appreciation. Now, that might sound complicated, but it's actually quite simple. Imagine you buy a painting for 10,000 rupees. A few years later, that painting has become a collector's item, and someone offers you 50,000 rupees for it. Congratulations, you just made a profit of 40,000 rupees. That 40,000 rupees is capital appreciation, the increase in value of an asset you own. And here's the kicker. You don't pay taxes on that profit until you sell the painting. So, the rich can hold on to assets like stocks, real estate, or art for years, watching their value skyrocket, and they won't owe a rupee in taxes until they decide to sell. Section 4. The buy, borrow, die loophole. This next strategy might sound a bit morbid, but it's a favorite among the ultra-wealthy. It's called the buy, borrow, die loophole, and it's all about avoiding capital gains tax. Here's how it works. First, buy. The wealthy invest in assets that appreciate in value, like stocks or real estate. Next, borrow. Instead of selling these assets and triggering capital gains tax, they take out loans against them. This allows them to access cash without actually selling the asset. Lastly, die. When they die, their heirs inherit the assets with a stepped-up basis. This means the value of the asset is reset to its market value at the time of death, effectively erasing any capital gains tax liability. It's a controversial strategy, but it's perfectly legal and highlights the unique advantages available to those with significant wealth. Section 5. Tax shelters, your money's safe haven. Think of tax shelters as legal havens for your money, places where it can grow and be protected from the relentless pursuit of the taxman. There are various types of tax shelters, each with its own set of rules and benefits. Roth IRAs. These retirement accounts allow your investments to grow tax-free, and you won't owe any taxes when you withdraw the money in retirement. Real estate depreciation. If you own rental property, you can deduct depreciation expenses from your rental income, even if the property's value is actually increasing. Trusts. These legal entities can hold assets for beneficiaries and offer various tax advantages depending on the type of trust. Remember, it's crucial to consult with a financial advisor or tax professional to determine which tax shelters are right for your individual circumstances. Section 6. You too can save on taxes. Start simple. Now, before you go dreaming of offshore accounts and complex trust funds, remember that you don't need to be a billionaire to start saving on taxes. There are plenty of simple, accessible strategies that everyone can use. Maximize your retirement contributions. Contribute the maximum amount to your EPF or other retirement accounts to reduce your taxable income. Claim all eligible deductions. Familiarize yourself with the various deductions and exemptions available to you, such as those for education expenses, medical expenses, or charitable donations. Keep accurate records. Maintaining thorough records of your income, expenses, and investments will make tax time less stressful and help you identify potential deductions. Remember, Even small savings can add up over time. The key is to be proactive and take advantage of all the legal tax-saving opportunities available to you. Section 7. Let's talk taxes. So there you have it, a glimpse into the world of legal tax avoidance. The rich have been using these strategies for ages, but now you're in on the secret too. Remember, knowledge is power. By understanding how the tax system works and the legal strategies available, you can take control of your finances and keep more of your hard-earned money. What are your thoughts on these tax-saving strategies? Share your opinions and experiences in the comments below. Let's start a conversation about taxes and empower each other to make informed financial decisions.